Hi everyone, this is Lee with Grizzly Bulls. Today we're going to answer the question, what is algorithmic trading? So I've been getting this question a lot recently because we launched Grizzly Bulls about a month and a half ago, and Grizzly Bulls, we design these algorithmic trading models. That's what these 7 cards here represent, are our 7 algorithmic trading models. And how they help you is we give off signals based on that they generate. So each of these models takes into account different indicators, and it has an evaluation engine for determining when it should trade. The top 3 are completely free. The bottom are premium with some affordable pricing for subscriptions to them. So basically, algorithmic trading is just taking instructions for how you want to execute trades, the conditions on when you want to buy and when you want to sell, and putting it into code and connecting it to your broker and have it run that for you. As our platinum model, we do allow you to have a managed account like that. We actually run an instance of the bot, our algorithmic trading bot for your account and trade based on the signals that the platinum model generates. For all the other models, we publish the signals either through email or API. Um, or you can also build your own algorithmic trading model if you want as well. That's a great thing to do. So just to learn a little bit more about what an algorithmic trading model really does, this is probably our simplest model. This is a mean reversion model. So it works by it only uses technical analysis, and it uses a few indicators we can see down here. So these are a few of the indicators it uses. So it's Bollinger Bands, Chandler-Millen oscillator, relative strength. So basically what it's doing at a high level, what it's doing is it's trying to find places to sell when the price has gone up too quickly to be sustainable. Of course, there is no hard set rule of the universe that says price can't just keep on going up and up and up. But historically, once price goes up too far, it's likely to pull back to a more normalized level. And then we have these technical indicators that tell us when it's gone up too far and when it's likely to pull down. So for instance, if the price has moved up, say 3% above the upper daily Bollinger Band and at least 1.5% above the weekly, and say the RSI is over 85, and that could be your sell condition. So that says that price has been going up too strongly recently. It's highly likely to mean revert or go back to a more normal condition, which means it's probably going to sell off a little bit. So we're going to short the market when we get that overextended signal. Then you also have to have a when you're going to rebuy. So you have to just make something up. Of course, whenever you design these conditions, you shouldn't just like pull them out of your head. What you should do is you should back test them, which is what we've done here. So, but first of all, let's just say the first condition we're going to test on a buy after we've sold from that mean reversion overextended signal is we're going to say when the price gets back below, let's say 2% below the upper daily Bollinger Band, um, then we're going to buy again. So we're kind of looking to make short trades. We're not going to make that many trades. Even though this is our most frequently trading model, 420 trades over uh, uh, almost 13 years now of data is really not that many trades. We can see the exact frequency is about one every 7.84 trading days, so about every week and a half, it's making a trade. So it's looking for times when the market is very overextended, to short, and then or to just get out of the market, to go to hedge to cash, and then rebuy once the market has re-entered a more normal channel. And so basically, when you're building an algorithmic trading model, what you do is you first just come up with your hypothesis rules. So something like I just kind of pulled out of my head right there. By the way, those are not the real rules this model uses. I was just completely making those up. But anyway, what you do is you make them up or hypothesize them, and then you test them. So you say, if I had run the model with those rules over this time period, how would it have done? And that's how we build these models. Of course, we also do it a little more advanced than that, and we have anti-overfitting engine. Because the problem with a lot of algorithmic trading models or just people that are backtesting any kind of thing in general is that they're overfit to past data. So we really don't want to overfit anything to past data. And some of the simple ways to not overfit data is to use really wide parameter bounds. So instead of being like, oh, I found in the back test that it works best if it's 1.0265% above the upper daily Bollinger Band. That's probably not a generalized enough rule, and you're probably like really um, tying that too closely to the past data, and it's probably not going to produce a repeatable pattern. Another sign of overfitting is if you're throwing way too many indicators at a single rule. Like say you found that often the market when it's 2% above the daily Bollinger Band, um, often it does revert back, but it really reverts back if it also is like RSI and it's like January 15th and it's the VIX is under 12. If it's good to use a combination of indicators, but if you throw too many indicators, what you're going to do is you're going to find, oh, this rule only worked here and it only worked here. There's 2 years out of a 13-year period. It's highly likely that pattern is not going to be a real pattern that repeats. You probably just overfit the data to those two specific instances. And so that's probably not a useful rule. And it's even probable that that kind of rule is going to cause you some problems in the future when you realize that your rule was just overfit. Of course, there's also machine learning. This is mostly we've been talking about heuristics, which are a bit simpler. But yeah, so that's what algorithmic trading is. We can look at let's look at a little more advanced model here. So this model, all of the algorithmic trading is based on those same principles. The difference in the models is which indicators they use, which heuristics they use, how their evaluation engine determines when to trade and when to buy, when to sell. And so this one, compared to the previous model, it actually trades less frequently, but it does much better overall. It's getting a 50% return compared to S&P's only 14% return. By the way, none of these models that we're looking at use any kind of leverage. So, and the max drawdown is pretty strong. That's minus 13% when the SPX in 2020 had a 36% drawdown. And so looking at like a little bit about how this algorithm works internally, this is a little sampling of the indicators that it uses. So it's a lot of things based on the VIX curve, the shape, and the absolute VIX level. So market behaves very differently if VIX is under 17 or if it's over 25, et cetera, like things like that. So VIX sensitivity, this kind of means usually VIX has a negative beta with the market. So if the market is up 1%, VIX is probably down like 3 to 5%, something like that. If the market is up 1% and VIX is only down 1%, or if it's even up, that's a very big sign that something fishy is going on. So that kind of thing. We also use some technical indicators, same as the other one. This one also uses some macro data. So we look at the unemployment rate, we look at the continued claims, initial claims, we look at a lot of housing market data. So that kind of gives us a bigger picture time frame of macro data is often most useful in determining the size of the moves. And so to look, it helps us not be as sensitive as we would. So if we're in a pullback in a very strong macro environment, it's likely that the market is going to bounce back quickly, 9 times out of 10. If we're in a pullback and we're in a weak macro environment, it's likely that if there is a bounce back, it's not going to bounce back much. It's going to maybe, it's going to bounce back here and then just continue on down. And so this is kind of some of the ways that this algorithm works. Anyway, today we've kind of answered what algorithmic trading is and how it can help you, even if you're not a programmer or you're not into technical analysis or anything. That's why we built this actually, because you can just get these signals in your email inbox and you can trade accordingly. You can also get them through API, or you can have a completely managed account. If you're interested in our Platinum account, just contact me and we'll get you set up. Thanks for stopping by today and I hope you learned something about algorithmic trading.